Question 1. Long-term care insurance (LTCI) benefits and triggers. Which of the following is typically considered a valid benefit trigger for receiving long-term care insurance (LTCI) benefits? A. Requiring assistance with cooking meals only. B. Requiring assistance with at least 2 activities of daily living adults. C. Requiring occasional assistance with financial planning. D. Requiring assistance with bathing, but no other adults. Answer: B. Requiring assistance with at least 2 activities of daily living adults. Explanation: long-term care insurance (LTCI) benefits are usually triggered when an individual requires substantial assistance with at least 2 of the 6 activities of daily living adults, which include bathing, dressing, eating, toileting, transferring, and maintaining continence. This is the standard under most LTCI policies and is in line with the Health Insurance Portability and Accountability Act (HIPAA) guidelines. Option A and C are incorrect because these are not typically considered ELs. Option D is incorrect because requiring help with only one ADL, such as bathing, is usually insufficient to trigger benefits under most policies. Question 2. Massachusetts insurance regulations. Licensing requirements. Which of the following is required for an insurance producer to maintain a valid long-term care insurance license in Massachusetts? A. Completion of at least 10 hours of continuing education related to long-term care insurance every 2 years. B. Completion of at least 4 hours of continuing education related to long-term care insurance every 2 years. C. Completing the licensing exam once every 10 years. D. Attending a state-mandated ethics seminar annually. Answer: B. Completion of at least 4 hours of continuing education related to long-term care insurance every 2 years. Explanation: in Massachusetts, licensed insurance producers who sell long-term care insurance (LTCI) are required to complete at least 4 hours of continuing education specifically related to long-term care insurance every 2 years. This ensures that agents remain updated on LTCI laws, regulations, and ethical standards. Option A is incorrect because the required education is 4 hours, not 10. Option C is incorrect as licensing exams are not repeated every 10 years. Option D is incorrect because the continuing education requirement is the focus, not an annual ethics seminar, though ethical standards are covered within continuing education. Question 3. Scenario. LTCI underwriting and claims. Mr. Thompson, age 65, recently purchased a long-term care insurance policy. After 3 years of premium payments, Mr. Thompson files a claim for long-term care benefits. His policy has an elimination period of 90 days and he requires help with bathing and dressing. He also has a waiver of premium rider on his policy. What should happen during the elimination period in terms of premium payments and benefit eligibility? A. Mr. Thompson is eligible for benefits immediately and his premium payments are waived during the elimination period. B. Mr. Thompson must pay premiums during the elimination period, but benefits will begin after the 90 days. C. Mr. Thompson is eligible for benefits after the elimination period, and his premiums will be refunded retroactively. D. Mr. Thompson must wait 90 days before benefits begin, but premiums are waived from the first day of the elimination period. Answer: B. Mr. Thompson must pay premiums during the elimination period, but benefits will begin after the 90 days. Explanation: an elimination period is the waiting period before long-term care benefits are paid, usually after the policyholder has triggered benefits by needing assistance with at least 2 adults. During this 90-day period, Mr. Thompson is responsible for paying premiums unless the waiver of premium rider states otherwise. Typically, premiums are not waived until benefits begin, meaning he must continue to pay premiums during the elimination period. Once the elimination period is over, benefits will start. Option A is incorrect because benefits do not start immediately and premiums are typically not waived during the elimination period. Option C is incorrect because there is no provision for retroactive refunds of premiums. Option D is incorrect because premiums are not waived from the first date unless specified by the policy. Question 4. Inflation protection in long-term care insurance (LTCI). Which of the following is a typical feature of inflation protection in a long-term care insurance policy? A. It allows the insured to decrease their premium by opting out of future inflation increases. B. It guarantees that the insured's benefits will increase annually by a fixed percentage, regardless of inflation. C. It automatically increases the benefit amount each year to help maintain purchasing power. D. It adjusts premiums based on the Consumer Price Index, or Answer C. It automatically increases the benefit amount each year to help maintain purchasing power. Explanation: inflation protection is a feature in many long-term care insurance policies that automatically increases the policy's benefit amounts each year to help the insured keep pace with the rising costs of care. This is critical as the cost of long-term care services tends to rise over time. Option A is incorrect because most inflation protection does not allow opting out to reduce premiums. Option B is misleading because benefits increase according to the chosen inflation rider, not a fixed rate. Option D is incorrect because inflation protection typically does not adjust based on the CPI but on fixed or compound percentages. Question 5. Suitability standards in long-term care insurance. Which of the following is not a factor typically considered in the suitability assessment for long-term care insurance? A. The applicant's financial ability to afford the premiums over time. B. The applicant's health status and history of chronic illnesses. C. The applicant's preference for specific nursing homes. D. The applicant's ability to perform activities of daily living adults. Answer C. The applicant's preference for specific nursing homes. Explanation: suitability assessments focus on determining whether a long-term care insurance policy is appropriate for the applicant based on factors such as their financial ability to afford the policy, health status, and potential need for long-term care services. While DLS are relevant to benefit triggers, personal preferences for specific nursing homes are not typically part of the suitability evaluation. Option A is a key factor because affordability is crucial. Option B is relevant as health status affects underwriting. Option D is important for understanding potential future benefit needs. Question 6. Types of long-term care services. Which of the following long-term care services provides temporary relief for a primary caregiver by allowing a qualified individual to care for the patient? A. Hospice care. B. Adult daycare. C. Respite care. D. Personal care. Answer C. Respite care. Explanation: respite care provides short-term relief for primary caregivers by allowing a trained professional or facility to care for the patient for a limited period. This is beneficial for caregivers who need temporary support. Hospice care is end-of-life care, and adult daycare B is a service where individuals receive care during the day but return home in the evening. Personal care D involves assistance with basic daily needs but is not aimed at giving caregivers a break specifically. Question 7. Scenario: LTCI policy exclusions and limitations. MS. Garcia purchased a long-term care insurance policy, but after several years she was diagnosed with a chronic condition that requires extended care. She submitted a claim for benefits, but her claim was denied because the condition was excluded in the policy. Which of the following conditions is typically excluded from most LTCI policies? A. Alzheimer's disease. B. Dementia. C. Drug or alcohol addiction. D. Parkinson's disease. Answer C. Drug or alcohol addiction. Explanation: most long-term care insurance policies do not cover conditions related to drug or alcohol addiction. Conditions like Alzheimer's disease, dementia, and Parkinson's disease are typically covered as they are common causes of long-term care needs. Option C is excluded due to the nature of the condition and the fact that LTCI is not designed to cover addiction treatment. Question 8. Policy structures and features. Which of the following is a defining feature of a partnership long-term care insurance policy under the Massachusetts Long-Term Care Partnership Program? A. The policy provides lifetime coverage with no limitations. B. The policy includes automatic inflation protection for all age groups. C. The policy allows the insured to protect assets equal to the amount of benefits paid under the policy when qualifying for Medicaid. D. The policy guarantees approval regardless of medical underwriting. Answer C. The policy allows the insured to protect assets equal to the amount of benefits paid under the policy when qualifying for Medicaid. Explanation: a key feature of partnership long-term care insurance policies is the asset protection element, which allows the insured to retain assets equal to the amount of benefits paid when qualifying for Medicaid. This feature encourages people to purchase LTCI policies and prevents them from having to spend down all their assets to qualify for Medicaid. Option A is incorrect because these policies do not provide unlimited benefits. Option B is partially true, but only certain policies for younger purchasers require inflation protection. Option D is incorrect because policies are subject to medical underwriting. Question 9. Federal LTCI tax treatment. Under federal law, which of the following is a tax benefit available for individuals who purchase a qualified long-term care insurance policy? A. Premiums paid for the policy are always 100% tax deductible. B. LTCI benefits are taxable as income when received. C. Premiums paid for qualified LTCI policies may be partially deductible as a medical expense. D. Only LTCI premiums paid after age 65 are eligible for any tax benefits. Answer: C. Premiums paid for qualified LTCI policies may be partially deductible as a medical expense. Explanation: under federal tax law, premiums paid for a qualified long-term care insurance policy can be deducted as a medical expense on an individual's tax return, provided that the taxpayer itemizes deductions and the total unreimbursed medical expenses exceed a certain percentage of their adjusted gross income. Benefits received from a qualified LTCI policy are typically not taxed as income, which makes options B and A incorrect. Option D is incorrect because LTCI premiums can be deductible before age 65, depending on the situation. Question 10. Medicaid and LTC coverage. Which of the following statements regarding Medicaid's role in long-term care is correct? A. Medicaid only covers long-term care services in nursing homes. B. Medicaid pays for long-term care services after individuals deplete their assets to meet eligibility criteria. C. Medicaid covers long-term care services only for those who purchased long-term care insurance. D. Medicaid offers unlimited benefits for all types of long-term care services. Answer: B. Medicaid pays for long-term care services after individuals deplete their assets to meet eligibility criteria. Explanation: Medicaid is a government program that pays for long-term care services once individuals meet strict financial and asset-based eligibility requirements, which often require depleting most of their personal assets. Medicaid does cover care in nursing homes, but it can also cover home care and other services, making option A incorrect. Option C is incorrect because Medicaid is available to individuals regardless of whether they purchased LTC insurance. Option D is incorrect because Medicaid has limitations on the types of care and the extent of services it covers. Question 11. Activities of daily living, ABLs, and LTCI benefits. Which of the following is typically considered a benefit trigger for long-term care insurance policies? A. The insured's ability to walk short distances without assistance. B. The insured's inability to manage household finances. C. The insured's need for assistance with dressing and bathing. D. The insured's difficulty in managing medications independently. Answer: C. The insured's need for assistance with dressing and bathing. Explanation: a common benefit trigger for long-term care insurance (TCI) policies is the insured's inability to perform two or more activities of daily living (ADLs), which typically include tasks like bathing, dressing, eating, toileting, transferring, and continence. Walking short distances (option A) and managing finances (option B) are not ADLs, and while medication management (option D) may be part of cognitive assessment, it is not typically one of the core ADLs. Question 12. Massachusetts LTCI advertising guidelines. Which of the following statements regarding advertising for long-term care insurance in Massachusetts is accurate under state guidelines? A. Insurers are allowed to exaggerate potential benefits as long as disclaimers are included. B. Testimonials from policyholders can be used even if they are paid without disclosure. C. Advertising must provide clear and truthful information about the policy's features and limitations. D. Insurers are not required to disclose changes to a policy and advertising materials. Answer: C. Advertising must provide clear and truthful information about the policy's features and limitations. Explanation: Massachusetts law requires that advertising for long-term care insurance be truthful, clear, and not misleading. Insurers must accurately represent the features and limitations of the policy. Exaggerating benefits (option A) or using paid testimonials without disclosure (option B) are not permitted. Option D is also incorrect, as insurers must disclose any changes to policies in advertising materials. Question 13. Long-Term Care Partnership Program Asset Protection. Under the Massachusetts Long-Term Care Partnership Program, how does an individual qualify for asset protection when applying for Medicaid? A. The individual must deplete all personal assets before applying for Medicaid. B. The individual must purchase a qualified LTCI policy that meets state requirements. C. The individual must demonstrate financial need regardless of their policy. D. The individual must prove that they have resided in Massachusetts for at least 10 years. Answer: B. The individual must purchase a qualified LTCI policy that meets state requirements. Explanation: the Massachusetts Long-Term Care Partnership Program allows individuals to protect a portion of their assets equal to the benefits paid out by their long-term care insurance policy, provided the policy meets state qualification requirements. This helps people avoid spending down all of their assets to qualify for Medicaid. Options A and C are incorrect because the purpose of the program is to prevent full depletion of assets. Option D is irrelevant to Medicaid eligibility. Question 14 scenario. LTCI claims process. Mr. Davis recently filed a claim under his long-term care insurance policy after being diagnosed with cognitive impairment. His insurer denied the claim, stating that the benefit trigger had not been met. Which of the following should Mr. Davis review to determine if he qualifies for benefits? A. The policy's elimination period. B. The activities of daily living annals criteria outlined in the policy. C. The cash surrender value of the policy. D. The premium payment schedule. Answer: B. The activities of daily living annals criteria outlined in the policy. Explanation: Mr. Davis should review his policy's benefit trigger criteria, which typically include the inability to perform a specified number of activities of daily living adults, or suffering from a cognitive impairment such as Alzheimer's or dementia. Option A refers to a waiting period before benefits begin, which is relevant but not directly related to qualifying for benefits. Option C relates to life insurance policies, and option D pertains to payment structure, not claim eligibility. Question 15. Federal LTCI tax treatment and deductibility. Which of the following statements best describes the tax treatment of long-term care insurance premiums under federal law? A. Premiums are never deductible as medical expenses. B. Premiums for qualified LTCI policies can be partially deductible as medical expenses based on the insured's age. C. All LTCI premiums are fully deductible from the first dollar. D. Premiums can only be deducted if the policyholder is over age 65. Answer: B. Premiums for qualified LTCI policies can be partially deductible as medical expenses based on the insured's age. Explanation: under federal law, premiums for qualified long-term care insurance policies may be partially deductible as a medical expense. The amount of the deduction is limited and increases based on the insured's age. Option A is incorrect because some deductions are allowed. Option C is incorrect as the deduction is not from the first dollar, and D is wrong because premiums may be deductible for people under age 65. Question 16. Massachusetts Consumer Protection Provisions. Under Massachusetts consumer protection laws for long-term care insurance, which of the following must be offered to policyholders? A. A 10-day free look period for reviewing the policy. B. Guaranteed issue regardless of health status. C. A 30-day free look period to cancel the policy for a full refund. D. The option to convert the policy into whole life insurance. Answer: C. A 30-day free look period to cancel the policy for a full refund. Explanation: Massachusetts law requires that long-term care insurance policies provide a 30-day free look period during which the policyholder can review the policy and cancel it for a full refund if they are unsatisfied. This protection ensures that consumers are not locked into a policy prematurely. Options A and B are incorrect because the free look period is longer than 10 days and LTCI policies are Medicare underwritten. Option D is unrelated to long-term care insurance. Question 17. Policy exclusions in LTCI. Which of the following is a common exclusion in long-term care insurance policies? A. Coverage for care provided in an assisted living facility. B. Coverage for services related to a pre-existing condition not disclosed at the time of application. C. Coverage for personal care and custodial care. D. Coverage for care provided by licensed professionals. Answer: B. Coverage for services related to a pre-existing condition not disclosed at the time of application. Explanation: most long-term care insurance policies exclude coverage for services related to pre-existing conditions that were not disclosed during the application process. This exclusion helps insurers manage risk. Option A is incorrect because LTCI typically covers care in assisted living facilities. Option C is incorrect as custodial care is often covered. Option D is also incorrect as LTCI policies generally cover care provided by licensed professionals. Question 18. Non-forfeiture benefits in LTCI. What is the purpose of the non-forfeiture benefit in a long-term care insurance policy? A. It allows the insured to transfer the policy to a family member if they no longer need it. B. It ensures the insured receives partial benefits even if the policy lapses due to non-payment of premiums. C. It guarantees the policy will continue with full benefits even if premiums are not paid. D. It provides inflation protection to the policyholder's benefits. Answer B. It ensures the insured receives partial benefits even if the policy lapses due to non-payment of premiums. Explanation. Non-forfeiture benefits ensure that the insured will still receive some level of benefit even if they stop paying premiums and the policy lapses. This feature is designed to protect policyholders who may no longer be able to afford the premiums after several years. Options A and D do not reflect the purpose of non-forfeiture, and option C is incorrect because non-forfeiture does not guarantee full benefits without premium payments. Question 19. Hybrid life insurance policies. What is one primary advantage of a hybrid life long-term care insurance policy over a traditional LTCI policy? A. Hybrid policies guarantee that long-term care benefits will always exceed life insurance benefits. B. Hybrid policies do not require any medical underwriting. C. Hybrid policies provide both a death benefit and long-term care coverage, ensuring some return if long-term care is not needed. D. Hybrid policies are more affordable than traditional LTCI policies. Answer C. Hybrid policies provide both a death benefit and long-term care coverage, ensuring some return if long-term care is not needed. Explanation. A hybrid life long-term care policy provides the dual benefit of life insurance and long-term care coverage. If the policyholder does not use the long-term care benefits, the death benefit is paid to their beneficiaries, offering some return on the premiums. Option A is incorrect because the benefit allocation depends on usage. Option B is incorrect as hybrid policies usually require medical underwriting. Option D is incorrect as hybrid policies can be more expensive due to the combined benefits. Question 20. Rate increases in LTCI. Which of the following factors can contribute to an increase in long-term care insurance premiums? A. An individual's change in health status after the policy is issued. B. The insured reaching a milestone age. C. Statewide increases in claims experience leading to higher rates for all policyholders. D. The insured filing a claim for benefits. Answer C. Statewide increases in claims experience leading to higher rates for all policyholders. Explanation. Long-term care insurance (LTCI) premiums can increase due to statewide or group-wide changes in the insurer's claims experience, meaning that if more claims are being filed than anticipated, the insurer may request a rate increase from the state regulatory authorities for all policyholders. Changes in an individual's health status after the policy is issued, option A, or reaching a certain age, option B, do not affect premiums. Similarly, filing a claim, option D, does not trigger an increase in premiums under most LTCI policies. Question 21. Elimination period in LTCI. Which of the following best describes the elimination period in a long-term care insurance LTCI policy? A. The number of days the insured must wait before coverage begins. B. The time frame during which pre-existing conditions are excluded. C. The amount of time after the policy is issued before the first premium is due. D. The number of benefit periods covered under the policy. Answer A. The number of days the insured must wait before coverage begins. Explanation. The elimination period in LTCI is a waiting period often ranging from 30 to 90 days that begins once the insured qualifies for benefits based on triggering events such as an inability to perform activities of daily living or cognitive impairment. During this time, the insured is responsible for covering their own long-term care expenses before the insurance benefits kick in. This period does not relate to pre-existing conditions. Option B, premium payment schedules. Option C, or the duration of benefit periods. Option D. Question 22. Tax treatment of LTCI. Under federal law, HIPAA is the tax treatment of long-term care insurance premiums for policies that qualify as tax qualified. A. Premiums are fully tax deductible regardless of age. B. Premiums are tax deductible up to a certain age-based limit. C. Premiums are not tax deductible under any circumstance. D. Premiums are only tax deductible if the insured is receiving benefits. Answer B. Premiums are tax deductible up to a certain age-based limit. Explanation. Under the Health Insurance Portability and Accountability Act, HIPAA, premiums for tax-qualified long-term care insurance policies are generally tax deductible, but the deduction is limited based on the insured's age. These age-based limits increase as the policyholder gets older. However, the premiums are not fully tax deductible, option A, and the tax deductibility does not depend on whether benefits are being paid, option D. Question 23. Inflation protection in LTCI. Which type of inflation protection increases the insured's LTCI benefits by a fixed percentage each year? A. Compound inflation protection. B. Simple inflation protection. C. Guaranteed purchase option. D. Non-forfeiture benefit rider. Answer B. Simple inflation protection. Explanation. Simple inflation protection increases the policy's benefits by a fixed percentage each year, typically 5% based on the original benefit amount. In contrast, compound inflation protection, option A, increases the benefits by a percentage of the current benefit amount, which grows each year. The guaranteed purchase option, option C, allows the insured to buy additional coverage without proving insurability, and the non-forfeiture rider, option D, provides some benefits even if the policy lapses. Question 24. Claim denial appeals process. If an LTCI claim is denied, what is the first step an insured should take according to most LTC policies? A. File a lawsuit against the insurer. B. Submit an internal appeal with the insurance company. C. File a complaint with the Massachusetts Division of Insurance. D. Hire an attorney to negotiate a settlement. Answer B. Submit an internal appeal with the insurance company. Explanation. When a long-term care insurance claim is denied, the first step is to submit an internal appeal directly to the insurer. This process is designed to resolve disputes without the need for legal action or regulatory intervention. Filing a complaint with the state insurance department, option C, or hiring an attorney, option D, are options that might follow if the internal appeal is unsuccessful. Question 25. Policy exclusions in LTCI. Which of the following is most likely to be excluded from coverage under a long-term care insurance policy? A. Care required as a result of an accidental injury. B. Care provided by a family member without certification. C. Skilled nursing care in a licensed facility. D. Hospice care for a terminally ill patient. Answer B. Care provided by a family member without certification. Explanation. LTCI policies typically exclude coverage for care provided by family members unless they are licensed or certified professionals. Care related to accidents, option A, skilled nursing care, option C, and hospice care, option D, are generally covered as they are consistent with the policy's intended purpose of paying for professional long-term care services. Question 26. Scenario. Suitability of LTCI for Mrs. Lopez. Mrs. Lopez is a 72-year-old widow who lives alone and has significant savings. She is in good health but is concerned about the potential future cost of long-term care. She has no children to rely on for caregiving. Based on this information, what would be the most suitable long-term care insurance option for Mrs. Lopez? A facility-only policy with a high elimination period and no inflation protection. B. A comprehensive LTCI policy with inflation protection and shared care provisions. C. An individual LTCI policy with the shortest elimination period and a large daily benefit. D. A federal long-term care insurance partnership policy with limited benefits. Answer B. A comprehensive LTCI policy with inflation protection and shared care provisions. Explanation. Given Mrs. Lopez's financial resources and her concern about the future costs of long-term care, a comprehensive LTCI policy with inflation protection would be the most suitable. This would cover both in-home and facility-based care, allowing flexibility for her future needs. Inflation protection ensures that her benefits keep pace with rising healthcare costs, while shared care provisions, typically for couples, might seem irrelevant in this case. It can still provide added flexibility, especially if Mrs. Lopez ever needs to share benefits with a future partner. Question 27. Medicaid and LTC coverage. Which of the following statements is true regarding Medicaid and its role in long-term care? A. Medicaid pays for long-term care only after private insurance is exhausted. B. Medicaid covers long-term care only for individuals under age 65. C. Medicaid covers long-term care, but only after the individual has spent down their assets. D. Medicaid does not provide any long-term care benefits. Answer C. Medicaid covers long-term care, but only after the individual has spent down their assets. Explanation. Medicaid is a means-tested program that provides long-term care coverage to individuals who have limited income and assets. Before Medicaid begins covering long-term care, the individual must spend down their assets to meet the program's financial eligibility requirements. Medicaid is a primary payer for long-term care services, particularly for those who have exhausted other resources. Question 28. Non-forfeiture benefit in LTCI. What is the purpose of a non-forfeiture benefit in long-term care insurance? A. To allow the insured to receive a refund of all premiums paid. B. To protect the insured's benefits if the policy lapses due to non-payment of premiums. C. To extend the benefit period for an additional term at no extra cost. D. To waive the elimination period after a claim is filed. Answer: B. To protect the insured's benefits if the policy lapses due to non-payment of premiums. Explanation: a non-forfeiture benefit ensures that the policyholder retains some benefits if they stop paying premiums, usually by providing a reduced paid-up benefit. This feature protects the insured from losing all coverage if they can no longer afford the premiums. It does not provide a refund of all premiums. Option A. Extend the benefit period. Option C. Or waive the elimination period. Option D. Question 29. Restoration of benefits rider. Which of the following accurately describes the restoration of benefits rider in LTCIA? It restores the maximum policy benefit if the insured recovers and no longer needs care for a specified period. B. It restores benefits once the insured files a second claim within the same benefit period. C. It extends the elimination period by an additional 30 days after a claim is filed. D. It provides a lump sum payment if the insured does not file a claim for more than 1 year. Answer: A. It restores the maximum policy benefit if the insured recovers and no longer needs care for a specified period. Explanation: the restoration of benefits rider allows the policy's benefit amount to be fully restored if the insured recovers from their need for long-term care and remains carefree for a certain period, typically 180 days. This feature helps preserve the policy's benefits for future use, ensuring that the insured still has access to coverage if care is needed again in the future. Question 30. Fiduciary duty of LTCI agents. What is the primary fiduciary duty of long-term care insurance agents when advising clients? A. Ensuring that the client purchases the highest possible coverage. B. Disclosing all potential policy exclusions and limitations. C. Promoting the insurance company's most profitable policies. D. Avoiding the discussion of other funding options such as Medicaid. Answer: B. Disclosing all potential policy exclusions and limitations. Explanation: LTCI agents have a fiduciary duty to act in the best interest of their clients, which includes providing full disclosure of the policy's exclusions, limitations, and other important details. Agents must ensure that clients understand the product they are purchasing and avoid misleading or withholding information. Promoting higher coverage, option A, or profitable policies, option C, is not aligned with fiduciary responsibility, and it is essential to discuss all relevant funding options, including Medicaid, option D.